You've probably heard this term thrown around, right? Wall Street's fear gauge. Sounds kind of dramatic, doesn't it? I mean, how can one single number possibly measure an emotion as complex as fear, especially in the middle of a chaotic market? Well, that's exactly what we're going to unpack.
So let's just dive right in with that nickname, the fear gauge. To really get what the VIX is, you first have to understand why it's so tightly connected to what you might call market anxiety.
And it's a totally fair question, right? Why does this world of hard numbers and cold hard charts even need a gauge for an emotion? Well, here's why. Because when investors start to get scared, they create something that is absolutely central to how markets move, and that thing is volatility. The best way to think about volatility is like turbulence on an airplane, you know? Low volatility, that's a smooth flight. Everyone's relaxed, prices are stable. But high volatility, well, that's when you hit a rough patch and prices start swinging all over the place. And that turbulence, yeah, it's almost always kicked off by investor anxiety. Okay, so we get volatility. Now let's pull back the curtain on the actual tool that's designed to track it. All right, so here it is, the VIX, which stands for the Cboe Volatility Index. What it does is give us a real-time snapshot of what the market thinks volatility is going to be. Specifically, it's forecasting how much the S&P 500 might swing over the next 30 days. And that keyword expects is everything. It's the whole game. The VIX is not looking backward, it's trying to look forward. So this thing was created by the Cboe Global Markets, and its real magic, its power, comes from that forward-looking nature we just talked about. It's not a rearview mirror, it's more like a pair of binoculars. And how does it get this predictive ability? Well, it does it by digging into the prices of S&P 500 options. And you can think of options as basically bets on where investors believe the market is headed. So, how in the world does the VIX take all of these thousands upon thousands of options prices and boil them all down into one single number? Well, the recipe, to put it lightly, is complicated. And I am not kidding. The official paper that explains the math is like 15 pages of pure, well, math. But hey, don't worry, there's not going to be a quiz, and you absolutely do not need a PhD in finance to get this. Just look at this. The calculation involves, get this, time to expiration measured in minutes, weighted averages, square roots, the whole shebang. We do not need to memorize any of this. The only point here is to see that this is a seriously sophisticated formula, built to digest an insane amount of data coming out of the options market.
You know, Investopedia put it perfectly. They said calculating the VIX isn't the way we would choose to spend a Saturday afternoon. Yeah, no kidding. And thankfully, we don't have to. It's just like driving a car, right? You don't need to be a mechanic to get where you're going. Cboe does all the heavy lifting for us in real time.
So, okay, forget all that crazy math. Seriously, if you remember one thing, make it this. The VIX is all about the price of options. See, when traders get nervous, what do? They buy options as a kind of insurance to protect their portfolios. That extra demand drives up the price of those options. And the VIX, it just captures all of that collective anxiety and spits it out as a single number. All right, so we've got this number. Now what? How do we actually read it? Well, the easiest way, by far, is to think of the VIX as a weather forecast for the stock market. And it's actually pretty straightforward. A low VIX, and we're generally talking anything below 20, is like a forecast for calm, sunny days ahead. It means investors are feeling pretty chill, they aren't paying a premium for that insurance we talked about. But a high VIX, let's say anything above 30, that's a storm warning. That's a hurricane watch. It means investors are expecting some serious turbulence and they're all rushing for cover, which, you guessed it, drives the VIX way up. So if the VIX is a forecast, it leads to the obvious question. Can you actually bet on it? And the answer is yes, you can, but, and this is a big but, you have been warned, this is not for beginners. Basically, investors come at this from two main angles. The first is hedging. Think of it exactly like buying insurance for your portfolio. If you think the market's about to take a nosedive, you can buy a VIX product that goes up when the market goes down. It's a shield. The second way is just pure speculation. This is where you're not protecting anything, you're just making a bet that things are about to get crazy, hoping to profit directly from the chaos. And how do they do this? Well, they use some really complex, pretty exotic tools. We're talking about VIX options, VIX futures, and even specialized funds with these weird ticker symbols like VXX or UVXY. And look, every single one of these carries its own unique and often significant risks. This is definitely not something you just dabble in.
So, let's bring this all together. What's the big takeaway? How should you or I think about the VIX when it comes to our own financial lives?
This quote right here really nails it. Look, the VIX is a fascinating indicator to watch, for sure. But actually trading it, that's a whole other league. It requires serious homework. So for most of us, its real value isn't as some fancy trading tool. It's just that simple weather forecast. It's a quick way to check the market's mood. And that leaves us with one last big question. So what is the VIX really? Is it some kind of crystal ball actually predicting the future? Or is it just a mirror reflecting the fear that's already out there? You know, the truth is probably somewhere in the middle. And that ambiguity, that's exactly what makes it one of the most watched and maybe one of the most misunderstood numbers on all of Wall Street.